Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Thursday, July 31st. We've had a very busy week as we're recording this on the eve of the tariff deadline, the August 1st deadline that was set by President Trump. So we don't have all the news yet, but we can certainly bring you up to date on what we've seen in terms of a flurry of news flow as this deadline nears. As usual, I'm going to share the slides, and I've called today's podcast Switching Up the Narrative, as it does seem that something fundamental has changed in terms of the balance of power in the last week. There's been international developments in terms of trips abroad. These tariff negotiations have been inked, as we discussed, and there has been a very subtle yet discernible shift in power in favor of the United States, and that has flipped some of the narrative that we have been discussing year to date. And I think what we need to figure out is whether that changes the outlook on the economic side as well. The picture I've used is from Scotland in the summer, which is where some of the action of this story took place, particularly as the president was playing golf on one of his holdings in Scotland, as well as hosting world leaders at the same place. As usual, we are going to discuss inflation, interest rates, equity markets, geopolitics, and other. And other in this case is a little touch on a little bit of a reversal in terms of the trend of the dollar, as well as some increased traction that we're seeing among digital assets. So, what are the sub headlines this week? Well, we're seeing growth surging, and we will show a picture of the US GDP, second quarter GDP, which is shown to have surged. Some of that may be distorted, but certainly it is a very strong headline figure. We have a defiant Fed, which, despite the hard hat incident that we saw over the last week and the showdown between the president and the chairman of the Fed seems to be defiant and holding rates where they are. We're seeing earnings season generally surprise quite generously on the upside, although we are seeing some divergence between the old economy and the new economy there, as we've noted before. And even the IPO market seems to have a burst of life as we are looking at the recent performance around tech stocks. So we'll discuss that as well. So not so much to say on the inflation front this week, although we do have indication that growth in the US has been very strong over the course of the second quarter. The figures that have been published are around 3%, a notable difference from the negative growth in the first quarter. So no back-to-back negative quarters there. Some of this 3% will have been a distortion. There will have been lower imports, and some of those imports were brought forward into the first quarter as the expectation of tariffs were mounting. The lower import figures will have had an effect, as that is generally a negative, that will have had an effect on the growth figure. But it's safe to say that this is a resoundingly confidence-inducing positive growth number that the US is showing. And it would again lead to a wondering by commentators or questioning as to why exactly this time would be why the Fed would choose to lower rates. So it should be, in fact, no surprise that they did not lower rates, but it would indeed seem to be quite a frothy market into be making that adjustment if so. Looking at the tariff picture, so I presented this chart that came in the Wall Street Journal in terms of how it started and how it's going. And there certainly has been a flurry of news relating to tariffs. We've seen that there has been a threatened tariff as high as 145% on China. Generally, as is the case in China, as is every other case, the actual agreed or imposed tariff has settled at a much lower number. The China number has settled as we speak today at around 30%. We know Canada was threatened as high as 35%, now back to 25%. Mexico, just today, July 31st, we know there is a further 90 days granted for the negotiation of a tariff agreement with Mexico. The EU is sitting at 15% over the 10% that it would have enjoyed just recently, but again, quite a bit lower than the 30% that was suggested. That 15% seems to be the magic number. It was a number used for Japan, South Korea, Taiwan at this point. We're still in the negotiation stage, as well as with India, and the UK has, thanks to its early mover and its separation from Europe, has been able to secure a tariff lower than the 15%. So we'll talk a little bit about what this means, these tariff agreements. At this point, they are headlines, they are agreements. Nothing is actually, the devil being in the detail, nothing is actually inked. And I would suggest, based on that old adage that winning is easy, governing is harder, that gaining these wins may in fact be somewhat easy in terms of at least breaking the deadlock, but the actual nuance of enforcing these is far harder. Moving to interest rates, as we mentioned, there has been a resounding defiance by the US Fed around any push for it to lower rates. And this defiance continued into this latest meeting. They have held rates steady. There was a notable dissent, however, with two officials who had both been appointed by President Trump backing a cut. So a little bit of a sense that there's starting to be some division within that organization. I would argue that some of that could be politically motivated, but I don't know at this stage. And certainly economically, it would be a strange time to lower rates. That keeping rates high did in fact boost the dollar, as the chart will show later shows. Well, markets have been true to form, as we noted. They have been reaching new records. Much of that has been driven not only by the strong economic data, the sense of uncertainty ebbing when it comes to trade negotiations, but also some of the very impressive earnings figures that came out this week with respect to the new economy and tech stocks. Stocks such as Microsoft, Meta, really saw a surge in their performance on the back of very strong growth in margins there. A lot of it related to AI, and we'll see later that this is pushing Microsoft as well as Nvidia into the $4 trillion market cap club. So very strong performance on the earnings season. And for the most part, we had said before that we thought that earnings had been very well managed in previous quarters. Some of the bad news, the gloom, the uncertainty had been got out of the way. And now that that is out of the way, there is more of a sense that this is now an ability to surprise on the upside. There was, of course, a tale of two cities when it came to earnings, and that we did have the old economy stocks like GM, like Ford, noting just how much of a toll these tariffs are taking on their margins. And with just flicking back to the tariff chart, if we look at that, we know that as these tariffs are now settling at much higher numbers than a minimum 10%, we can now expect that there will be many other companies also citing tariffs as a source of erosion of their margins. The important thing to note before is that previously, perhaps these tariffs had not gone into effect, or there was an inability to forecast. Now that these so-called arrangements have been inked, it will be much more difficult to evade having to factor these numbers in. So I would expect much more of a concrete effect of these tariffs into earnings going forward. So as we noted, equity markets doing very well. And the really surprising point is the returning to favor of IPOs. And the biggest IPO headline grabber of this week was Figma. So another tech stock, in this case, a design software company that was able to price at the top of its range, IPO of over 1 billion, the first billion plus IPO in the Bay Area for almost 5 years, according to the Wall Street Journal. So that's clearly a very strong sign of buoyancy. This has been, and there have been 4 IPOs since the beginning of the year, all of them strong tech stocks. They've all performed well. So whereas this may give some cheer to venture capital in that the IPO market is not in fact closed, I would say that this is quite sector specific, and we're not seeing a broad swathe of IPOs have success clearly anymore. It simply is a very sector specific story. Looking to the relative performance of US markets, and we've spoken before about this slow erosion of US exceptionalism, which did seem to take place in the aftermath of Liberation Day. The other factor that was working against US exceptionalism was the perception that countries in Europe, as well as other trading partners, were starting to forge their own bilateral alliances, and that this was a way essentially of circumventing the US as a perceived unreliable trading partner as the trade was being reset and policy was being reset. I'd say if we were to look then at the regaining of the ground, we can see that there really has been a reversal of this script, of this narrative around US exceptionalism no longer being the dominant play. We can see that relative to the rest of the world, whereas in the aftermath of the election day and inauguration day, S&P 500 did underperform relative to the rest of the world. We see now that it is starting to outperform again, and that has basically lower than it was in the run up to election day, but is still outperforming. And whereas it's not at this point close to its 200-day moving average, it is still getting very close to that. So outperformance of the US versus the rest of the world continues to be part of the narrative. We've spoken about how these very large companies are continuing to get larger, and it seemed like just yesterday that we spoke about Nvidia passing the $3 trillion market cap. We know that that's now going close to the $4 trillion mark. Microsoft very close behind, Apple itself hovering around the $3 trillion mark, but quite astounding in terms of the growth there and really just the dominance of these companies as they start to get larger in terms of market cap. We know that indices based on this will start to represent more and more of these stocks, and it is going to look more and more concentrated as time goes on. We have heard also in all of the earnings statements about a massive doubling down of commitment to invest in data centers, invest in AI, use CapEx for this purpose, with no seeming limit to what these cash-rich companies are prepared to pay. So on that basis, we would say that there is plenty of runway for certainly companies like NVIDIA to go a lot higher in terms of market cap. And I do think we need to think at some stage about just what kind of a stock market we will be living in when we have these stock, basically individual companies where the market cap exceeds that of many separate countries in the world. What does that do to the American exceptionalism thesis? What does it do to the ability to hold a broad slice of the market when certain companies are just so outsized in terms of their size? Again, we talked last week about a vibe check, and I think this is something we should probably continue every week, at least for the summer vibes. We've been speaking before about the disproportionate effect of tariffs. Forward earnings projecting now a $2 billion tariff blow. And this is on the back of GM's profit that we noted last week shrinking after a $1 billion tariff hit. We're seeing quite a bit of volatility in commodities markets as the new tariff news comes out. We've seen US copper prices rise. We've seen them fall. It's unclear at this point just what the tariff implications on metals are going to be. And what we do know is that just as this affects US copper prices, this has a significant effect on the exporters of copper, such as Chile as well. So we will be returning to the story as we think about the clarity that's coming from some of these tariffs. And of course, there is no such thing as operating in isolation, and any of these tariffs always will have some collateral damage, intended or unintended. And clearly right now, this has been a low point, a low week in terms of European morale. We've seen headlines such as Europe's summer of humiliation as the deal with the US has been parsed. It has seemed that there has been very little in terms of the wins for the EU in this deal. Not only have they been forced to take essentially a tariff of 15%, which is 50% more than they had just recently of 10%, they now have commitments in the significant range to invest in the US, both to buy defense equipment from the US, as well as to invest in US technology and infrastructure. So really a lose-lose as far as Europe is concerned. But we might even call it a lose-lose-lose, as what they've also lost is credibility, esteem, and I think some of the respect that they would have had within their domestic political, say, setups in terms of the ability to withstand pressure from the US. Even the optics of the meetings in Scotland that were held on Donald Trump's property, it did shift the balance quite perceptibly. And this was also the case when it came to at the meeting with the EU and Ursula von der Leyen. So I'd say that all of that is stacking up, that there has a strong leader has emerged with the ability to flex its muscle, and Europe has been seen to be fragmented in disagreement and unable to withstand the pressure from this trading partners who are being forced to cede. So a lose in terms of Europe. And if we were to even make it a lose, we also see that the euro has been weaker, certainly in the past week, as there is a sense that the economic uncertainty is not over. This does not place Europe in a particularly strong position. Now, for a bloc as committed to trading as Europe, having a weaker euro might actually be beneficial, but certainly it does reflect a lower confidence in the enterprise. Other collateral damage extends to Brazil, and we've seen an extraordinary reach by the US president into Brazil domestic law and order matters, placing sanctions on the judge that is trying former President Bolsonaro, taking its tariffs to 50% against Brazil, and that leading Brazil then to double down in defiance of President Trump. So there is still a standoff in place as we write and speak between the US and Brazil. We're also seeing Donald Trump slamming India and Russia at this point. It wasn't so long ago that he was touting and quite optimistic about trade deals with India. Because India and Russia have secured some bilateral cooperation, there has been a threat of a 25% levy against India and a condemnation both of those economies as dead economies. So quite a bit of collateral damage, some regrouping clearly being attempted, but nothing at this point really being secured. Again, looking at the reliance of certain economies on the US, Ireland would be a good example of one that is highly reliant on the US, particularly as it relates to pharmaceutical exports. So there was an interesting Financial Times article this week, a big read around just how much of an impact that this uncertainty around tariffs could have in Ireland, and perhaps exposing the risks of being too reliant on a single trading partner. Again, we've mentioned the dollar having had a slightly better week. Overall, the long-term narrative was weaker, even despite the tariff excitement and some of the tariff strength. The chart on the left showing the Bloomberg dollar index generally heading down, although it did strengthen somewhat against the yen and against the euro in the past week. We have seen the US currency having its best month this year, up about 2% after 6 consecutive months of losses. So that will be indication of some kind of resurgence of confidence in the US dollar. And this very strong growth number is also a strong offset to the concerns around the budget deficit, on the belief that growth is certainly the antidote to debt in terms of the ability to grow one's way out of debt. And finally, looking at Bitcoin, we have increasingly heard about tailwinds around digital assets over this past week, more headlines about banks such as JP Morgan starting to do more deals with exchanges around digital assets. We can see that public companies have become big crypto owners, 160 public companies now owning Bitcoin, as well as 12 governments, funds and private companies. So gaining more and more traction. We still believe there's quite a bit of uncertainty as to how Bitcoin itself behaves, but quite a bit of traction coming into digital assets. So I'd say watch the space for the rest of the summer, particularly as some of the tariff news gets pushed to the background and we hear more and more about the digital asset situation. And that is it for this week. It has been a bit of a whistle-stop tour through many topics. It's been a very busy week in terms of trade information, and we're really still midweek. I'd say, given the 1st of August is a few hours away, we will no doubt have more deals on the horizon, and we will come to you next week from South America, where we will be hearing from some representatives on the ground about the Chilean economy initially, and look forward to checking in with you then. Thank you, everyone.